Welcome back. We are busy with Unit Standard 242-555. We are now discussing the specific outcome 4, propose a wealth preservation solution. Right. If we look at the first assessment criteria in this section, a financial wealth preservation solution that meets the wealth management needs of the client, legislative requirements are presented to the client. So that's the assessment criteria coming from the qualification document. We are now going to look at activity 1. After you've gathered the client information and established his or her needs and wants, you will need to compile your investment strategy, explain the process you will need to follow when you allocate assets and investments. One starts off by determining the client's investable funds. These funds are then divided into 3 or 4 categories: cash and short-term deposits, medium and long-term capital market assets, equities, and hard or venture assets. Each broad category can then be divided into a number of subcategories. Under short-term deposits, one would consider cash, call accounts, notice deposit accounts, and money market funds. These are covered in the money market section. Under medium and long-term debt instruments, one would be looking at gilts, annuities, fixed deposits, participation gilts, etc. And these one can have a look at in the capital market section. One would also need to decide whether one would include domestic equities, property, and investment hedges. Within the equity section, one needs to decide how one will allocate funds between different asset styles, and this would apply both international and domestically funded investments. Within the property element, one would need to distinguish between direct ownership, that's where you own a property, or property trusts or property syndications. Under the investment hedges, one would consider Kruger rands, futures, options, and possibly tank containers. A hedge instrument is one that protects the investor against a particular contingency. Gold, for example, is hedged against rapidly rising inflation. These days, sophisticated investment managers would use derivatives to hedge a position. Let's have a look at activity 2. The timing at market entry and the timing at market exit are important when dealing with any equity-based investment. Name 3 methods by which the timing decisions as risk may be reduced. Right, one of them is increase the term of the investment, phasing in lump sums by means of recurring investments, withdrawing lump sums piecemeal over time, or leaving the decision making to an experienced fund manager. If we look at activity 3, how will you go about implementing recommendations made to a client? Check the clients understand your recommendation. Agree with the client with recommendations should be implemented. Agree if the recommendations should be implemented at intervals and what the intervals are agreed on and what specific time frame. Look at the client's affordability first. Generate quotes on products that will address the shortfalls, and look at the client's priorities and suggest your recommendations. Right, assessment criteria 2. The agreed strategy is implemented and management plan is developed to allow for a review. Now remember, once you invest money for a client, you can't just leave it because the markets are moving up and down and there is certain things happening in the world. So you need to go back to the plan and see whether it still makes sense, and then obviously re-implement a new strategy if needed. So let's have a look at activity 1 under assessment criteria 2. Once you have completed your recommendations, you now need to implement it. Explain the process you will follow in order to implement the strategy that you and the client decided on. Right, so once a strategy has been devised and agreed to, the financial planner and the client must now decide how it will be implemented. At this stage, it is necessary to consider the position of those funds over which the client and the financial planner have no control. These needs to be deducted from the amounts to be allocated to the various asset classes. If the client has existing investments, one needs to determine whether they will be retained or if you're going to sell them. If they are to be sold, the most cost effective way of doing this must then be followed. If money is to be invested overseas, the necessary steps and procedures have to be followed. One also has to consider the tax. If interest bearing accounts are to be used, it would be better to house them in an instrument which is more tax efficient because the tax would be paid at a lower rate in the investment that would be paid by the individual. One also needs to decide whether the money will be invested in immediately or phased in over a period of time. Different decisions may have to be taken for different asset classes. Right, if we look at activity 2, the next step after implementation of your suggested strategy is to provide follow-up service to the client. How would you go about portfolio revision and reporting the performance of suggested instruments in the portfolio? So it's always important that you can't leave the client after you've done a planning for him. You've got to go back to the client and follow up with the client to make sure that he is still comfortable with your suggestions and with the portfolio you put together. So the portfolio need to be monitored on a regular basis, depending on the investment strategy chosen. That revision may be done on a very regular basis, on at least a less regular basis. It is the financial planner's interest to report back to the client on a regular basis. The client should know how his or her funds are invested and what chances have occurred or changes have occurred in the portfolio. An educated and informed client is more likely to stay with a financial planner than a client who never hears from the planner and does not know what is happening to his and her investments. Especially when there's a downturn in the market, clients get very concerned about the investment and whether they made the correct decision. And it's important that you, as a financial planner, will report back to them and just calm their nerves and say to them, just hang on, the market will turn back and don't jump out of your investments right now. So, in conclusion, an effective portfolio is one that gives an investor the best return for the risk that is taken. Alternatively, an efficient portfolio can be seen as one that gives the desired rate of return at the least risk. An investment portfolio also needs to be regularly reviewed in order to ensure that it still meets the investor's needs and matches his risk profile. Thank you very much for attending our session on Unit Standard 242555. This then ends the specific session, and we will then move on to the next unit standard in our next sessions. Thank you very much.